Hello everyone. Today we are going to run financing decision. It is about this part. So where the money comes from? Financing decision. There are two sources of long-term capital. The imbalance sheet, the bond becomes debt and stock becomes equity. So some firms has large debt and some firms has small debt. And now we are going to run what proportion is good for the firm. It means find optimal capital structure to maximize the firm value. There is no tools. We will learn from theory, the MM theory. So there are two types of risk: business risk and financial risk. Business risk is regarding operating leverage. Financial risk is regarding financial leverage. We will learn these two first, and then we find some optimal capital structure and capital structure theory. Let's start. This slide shows what is business risk. Business risk is regarding the future operating income, EBIT, and the risk is related with uncertainty. So we can say business risk is uncertainty about future operating income. Future operating income can be measured by EBIT, earnings before interest and tax. So for example, how well can we predict operating income? That is a question about the business risk. As you can see, both are same EBIT, but different risk, right? Which one is more riskier? Pink line, right? Pink line has more flatter line than red line. So we can say it means greater probability of losing a lot of money, right? What determines business risk? Business risk is related with the future operating income, and future operating income can be measured by EBIT, earnings before interest and tax. So we can simply understand EBIT can be measured by total revenue, and revenue also can be calculated by total sales, right? And subtract some cost, total cost. And this equation also can be calculated by the price multiply quantity sold. And total cost can be decomposed two parts. The first one is the fixed cost, and second one is variable cost multiply Q. So these factors can affect the business risk. So uncertainty about the demand, the sales here, right? And uncertainty about output price here. And uncertainty about the cost here, right? And operating leverage. And what is operating leverage? Operating leverage is the use of fixed cost rather than variable cost. As you can see in this equation, this part, when firm use more fixed cost, it means firm use the more operating leverage. What is leverage? Leverage it means in Korean the 지렛대, right? So if you have a leverage, you can magnify the things. And how firm increase fixed cost? Just purchase a lot of fixed asset. This slide shows the effect of operating leverage. So I copied the previous equation, and as you can see, there are two graphs. and the BE stand for break-even point. It means in this point EBIT equal to 0. And there are two lines, the revenue and total cost. The slope of revenue is what? The price, right? Because the x-axis is Q, quantity sold. So slope of revenue is P, and the slope of total cost is what? Here, right? So variable cost. As you can see, the total cost line is start not 0, right? The intercept means what? This point means, yeah, peak FC, the fixed cost. As you can see, the second graph, it has more fixed cost, right? In this case, the EBIT fluctuates more, right? When PAM use small fixed cost, EBIT fluctuate here, but when PAM use more fixed cost, EBIT fluctuate more. What does it mean? Yeah, fluctuation is called business risk. So PAM can use operating leverage to get higher EBIT, but the business risk also increase. So here we can say the business risk also increase. So high operating leverage, it means high business risk. So as you can see, when PAM use more high operating leverage, it has more flatter line, right? So when PAM use low operating rate, it moves here to here. But when PAM use more operating leverage, it fluctuates more, right? Yeah, it means more business risk. Now we run the business risk and operating leverage, and let's move to the second risk, the financial risk and financial leverage. What is financial leverage? Yeah, financial leverage is about the use of debt. Here is an example to illustrate effect of the financial leverage. Let's assume two firms with the same business risk. And the different thing is with respect to their use of debt. The use of debt is regarding capital structure, right? So there is two firms. Firm U means unleveraged. And L means leveraged. So unleveraged firm, it has no debt. But leveraged firm, it has 10,000 of 12% debt. Yeah, that is different thing. And the total asset and tax rate is same. Assume there's three economic conditions, the bad, average, and good. And this is a probability. And in this case, it has different EBIT, right? This is a given number. And let's calculate the interest. Yeah, this is unlevered firm, so it has no debt. So this is 0, right? And what about EBT? EBT, just subtract these two. So 2,000, 3,000, 4,000, right? and tax, multiply tax to EBT, so multiply 40%, then we get 800, 1200, and 1600, right? And finally we get net income. This is 1200, 1800, and 2400. This is levered POM case, and let's assume the probability of economic condition and EBIT is the same as for POM unlevered. And let's calculate interest first. When POM borrow $10,000, they should pay 12%, right? So the interest is 12%. So interest is here, 1,000. Yeah, this number comes from here, right? We borrow 10,000 and the interest rate is 12%. So this money, right? And then EBT, just subtract these two, then get 800, 1,800, 2,800, right? And what about tax? Yeah, multiply here, right? 40%, and then you get this number. Finally you get net income, right? Net income is this amount, this amount, this amount, right? We want to calculate BEP and ROE. So this slide ratio comparison between levered and unlevered POMs. So what is BEP? Yeah, BEP stands for basic earning power. So this is basic earning power. What does it mean? Yeah, it means the ability of firm's asset to generate operating income. So it's useful when comparing firms with different debt and tax situation. So it can be calculated by EBIT over total asset. So in this case, total asset is here, right? 20,000. So input the 20,000. And EBIT, where is EBIT? The economic bad case here, right? At 2,000. So you input the number, then you get 10%, right? So it is 10%, and repeat this process, you get 15%, 20%, and levered case, we assume the same EBIT, right? So it is same as for POM U, and also their total asset is same. So their basic earning power also same, right? And second, we want to calculate ROE. ROE stands for return on equity, and it can be calculated by net income over total equity. So in this case, unlevered PUM. Okay, let's calculate levered PUM first. In the balance sheet, their total asset is this amount, and debt is what? This amount of money. So equity is this amount, right? And unlevered PUM, there's no debt, so total asset and total equity is the same. Total asset is this amount, and total equity also this amount. That is different thing, right? So when we input the numbers, the bad case first, total equity is this amount, and net income is here, right? So we can get the final number that is 6%, and you can repeat this process, you get these numbers. And what about the levered PUM? Levered PUM ROE, total equity is here, right? So this amount, and net income is here. So ROE, the levered PUM, bad case, 4.8%, and repeat this process, you get these numbers. Calculate expected values. Expected values of BEP, basic earning power, the PUMU. How can I calculate this? We get basic earning power of each scenario, right? And we also know each scenario's probability. The bad case probability is 0.25, average 0.5, and good case 0.25. And we can calculate expected value as probability multiply each scenario, right? So 0.25, this is probability of bad case, and BEP was 10%, and average case, the probability is 0.5 multiply 15%, and good case probability 0.25 and multiply 20. Then finally you get 15%. And you can also apply levered PUM, and you get the same number, right? Because we assume the same probability and same EBIT. What about ROE? With this process, we can calculate each scenario and then multiply each scenario's ROE, right? So bad case ROE is 6%. And average case 9%, and good case 12%. And some of these you get 6%. No, 6. This is 9%. And levered PUM, you can calculate this number, 10.8. Now we try to calculate standard deviation ROE. Do you remember the general formula to calculate the standard deviation? At the risk and rate of return part, we already learned here, right? The standard deviation can be calculated using this equation, right? This is probability, this is mean, and each scenario's expected return, right? So in our case, PUM used standard deviation of ROE can be calculated by the probability multiply the bad case the ROE, the 6%, the mean is 9%, and power of 2. Probability 9%, 9% power of 2. 12%, 9% power of 2. Is it n? No. We should power of 1 over 2, right? Yeah, because there is a root. So if you calculate this equation, you get this number, 2.12%, and POM L 4.24. Can conclude that for basic earning power, it is unaffected by financial leverage. As you can see, unlevered POM and levered POM, it has same expected BP, right? Same expected basic earning power. So the financial leverage does not affect this, right? But for ROE, return on equity, L has higher expected ROE, right? As you can see, the levered POM has more return on equity. It means it increased the performance measure, right? Yeah, higher ROE is more good for POM, right? And levered POM, much wider ROE swing. Yeah, we calculate standard deviation, right? As you can see, standard deviation levered POM is more higher number, right? So finally, we can conclude that each higher expected return is accompanied by higher financial risk, right? So accompanied by higher financial risk. And there is one more important thing, is there is one condition: expected BEP should larger than RD. So in this case, expected BEP of the levered POM is 15%. So this is 15. And RD was what? The cost of debt is here, right? 12%. So from this condition, L has higher expected ROE. Why? You can simply understand expected BOE, that is what means what? Yeah, it means the basic earning power. So we can write as this: it is ability of the POM assets to generate operating income. So each kind of operating income concept, right? And RD means what? Yeah, how much money when you buy low from investor. So each kind of cost, right? Each kind of cost, and this is kind of income. So income should be larger than the cost, right? So we can simply understand this equation, this condition. In addition, you can prove that with a mathematical equation. So we can write that as this: expected ROE of unlevered POM, expected ROE levered POM. Yeah, when you want to this relationship, it needs this condition, expected BOE, BEO, basic earning power should be larger than cost of debt, right? So ROE is what? ROE is total equity. The numerator is net income, right? So unlevered ROE can be write as this: total asset, but there is no debt, and net income can be calculated by EBIT subtract RD minus D, but there is no debt, so 0, and 1 minus T. And right hand side, TA, total asset minus debt, that is total equity, right? And net income is EBIT minus RD multiply D. This is what? Yeah, this part is interest, right? Yeah, interest. And multiply 1 minus T. And rearrange this equation, you can write as this: total asset minus debt multiply EBIT smaller than total asset EBIT minus RD multiply D. And finally you get this equation: debt multiply EBIT. This minus, so change the sign. TA RD multiply D, and this is TA EBIT should be larger than RD, right? Because we can cancel out this and this and rearrange this equation. Finally we get these numbers, this equation. And what is this? EBIT over TA means what? It means, yeah, expected BEP, right? And should be larger than RD. So we can prove from the equation, but you can simply understand intuitively the return should be larger than cost, right? So in this case, return is operating income. So operating income should be larger than cost, and then we get some more expected return on equity, right? Summarize this lecture. We run some two types of risk, right? The business risk and financial risk. And business risk is related with operating leverage. So operating leverage it means what? Use of fixed cost. So if this fixed cost increase, it means what? Expected EBIT goes up, right? And but also risk goes up. Expect standard deviation of the EBIT goes up, and finally business risk goes up, increase, right? And second, we run financial leverage. it is about use of debt. So if the use of debt increase, what change? Expected ROE, return on equity, increase. Then, but also risk increase, right? Standard deviation of ROE increase. It means what? It means financial risk increase. And it needs one more condition, right? Yeah, the given expected basic earning power should be larger than the cost of debt, right? So from this condition, we can get more expected ROE, right? Yeah. That is end of this lecture. Thank you.